Thanks for having me. This is, I think, my 5th metals investment forum since we started last year, right before we IPO'd. Since a little bit of preamble here, since that first presentation, we'd already set out these milestones that after the IPO, we wanted to do some drilling, we wanted to confirm the resource and update it, we wanted to release a PEA, and we've hit all those milestones. And along the way, we've, I think, exceeded everyone's expectations, and we've certainly got a lot of love in the market. If you think that our team is done now, I don't think you understand our team. We have an intensely dedicated and extremely talented group, and we also have me, hired only for my roguish charm. But we believe there's a lot of milestones left for this project, and we feel that there's ample opportunity to make this better and build on this. So I'm not going to, the sort of lead-in shares, or slides, I'm going to be pretty quick through here. So people who know us, we're IPO'd last year, built this company around a pretty tight share structure, purpose-built for shareholder returns. We've kept it tight. We've not issued any warrants except agent warrants. We successfully completed a $12.5 million financing in February. We went out for $10 million, and in 48 hours we closed on 12.5 with Resource Capital Funds out of Colorado leading that. Groups like that do an incredible amount of due diligence, and that was a massive vote of confidence in the company and project and team. In January, we released a resource update. We took what was a resource about 60% this size and grew it substantially. We're up now to 11.2 million tons indicated, around 9.6% zinc equivalent, and 39.5 million tons at around 10% zinc equivalent. For a project of this scale located in a mining-friendly jurisdiction, Joe's comments on political and jurisdictional risk, in terms of permitting and political and jurisdictional risk, Yukon is about as good as you get. And so what does a resource like that get you? You see in this chart here, this is all the zinc deposits in the world, or at least the vast majority of them, that sit to the right of or above those two lines. So that's above 7% zinc equivalent and greater than 50 million tons. So there are two juniors on that list. There's Macmillan Pass, you see, which is highlighted there, and there's the Taylor deposit, which is in Arizona mining. Every other deposit on that list is owned by a major or mid-tier at minimum. So we are a unique company, and Arizona mining has a $1.3 billion valuation to our 60 million. So to say that we're a unique company and that we don't have room to grow is to underappreciate the rare quality of this asset, both in terms of size and grade. And so as Joe said, Wednesday we released our PEA, and this was the culmination of a lot of hard work for the team. We built this on a base case of 121 zinc, 98% lead, and 1680 silver. And it's important to mention that we picked those prices not out of a hat, but on the basis of a formula that was 3 years back and 2 years forward on the forward curve. And so what we see there is on the back of a $404 million upfront capex, you see a $448 million after-tax return, NPV, and a 24% IRR, and an 18-year mine life. And that is critical in terms of having an asset that can survive the downturns. That 18-year mine life is of utmost importance. In terms of the benchmarks for success on a long mine life base metal asset, greater than 20% IRR, NPV higher, after-tax NPV higher than capex. This project hits all the high notes and has a capex that is still manageable for a junior to pay. So a little bit of conceptual mine plan there. You see that we're effectively running 2 mines in 1 mill. So you see the Tom deposit on the right and Jason on the left. Perhaps it's a bit of surprise to most people. We're starting with starter pits on both Tom and Jason. We did a lot of iterations on this, trying to think of what was optimal, and decided that what we were going to go with was not necessarily the largest economic case, but a balance of economics and what we thought was permitting, ease and ease of close and remediation. So for example, the starter pit at the Jason site is large enough only that 100% of the waste rock, which we had to assume was 100% acid generating in the absence of data to the contrary, 100% of that waste rock goes back underground as backfill for the underground mine life, and the vast majority of the Tom waste goes underground likewise. The Tom pit was sized to limit it so it didn't interfere with any natural water courses. Is there opportunity to improve that? Yes, and we'll talk about that later. So broadly speaking, over the life of mine, we're starting with a 3-year open pit operation, about 4.3 million or 4.2 million tons of mineralized tons coming out of that, and transitioning in year 3 into a 16-year underground mine life. Starting with a starter pit, 2 starter pits with minimal initial strip means that we're able to fund the underground development for the underground mine life out of cash flow in the first 3 years. And that makes a huge difference in terms of your upfront capex on a project like this. So you see that we mostly have done a pretty good job about front-loading the high lead and silver zones into the first 10 years of the mine life to really improve your return. And capital costs, without dwelling on the specific numbers here, I want to highlight the number of offsite infrastructure, 78 million. And you add into that the associated project indirects, EPCM, owner's costs, and contingency on that. And that ends up being 105 million to upgrade the Canal Road from Ross River to our project site. That is 105 million we've earmarked of our capex over 1 quarter to upgrade a government road. In terms of opportunities, which I'll get a little bit into later, obviously we see a massive opportunity to get support from the government, if not outright offloading that cost to the government. In terms of operating costs, this is a relatively remote mine site. We've never denied that, and one of the things that we were always confident about the PEA was that it was going to show, although you do have, and as we show there, almost $212 per wet metric ton for both the zinc and lead concentrate to get them to smelter in Asia. This has sufficient mining margin because of the high grade and size and scale that you can eat that cost. This is going to be a competitive cash cost mine. I did not include cash costs in here because unfortunately, unlike gold, there is no all-in sustaining cost standard. So depending on which of our peers you compare us to, they all use a different standard. So we're going to get a little more clarity on that in the coming weeks as I decide exactly which standard I want to mimic of my peers. Metallurgy, we released a metallurgical results a week ago or just over a week before our PEA. And that particular news release, the first thing I want to highlight is obviously good recoveries, good concentrate grades. But we straight up put an appendix in that news release that showed the assay levels for all the penalty elements. Not a lot of our peer groups do that. People generally speaking with a base metal project where you're shipping concentrate, a lot of juniors will be quite deceptive about what penalty elements they might have and what their concentrate looks like. In fact, they try to avoid talking about that as much as possible because they're afraid of what implications there might be. For us, we were quite happy to put that appendix in, lift our kilt, so to speak, and let people take a look. We'll pay a modest penalty over life of mine on mercury and potentially silica, which we can manage. But ultimately, this is an extremely clean concentrate. This is low iron and zinc concentrate, which is desirable. And this is not just a concentrate that is saleable, this is a concentrate that's going to be desirable. And in terms of being able to market your concentrate in periods of oversupply, that is really critical. So this slide's a bit busy, and I just wanted to kind of show, I realized when we released our news release, there was some criticism. We didn't cover enough scenarios, so I want to kind of point out a few things. Obviously, base case scenario here, which we talked about the spot price scenario with 142 zinc, 105 lead, 1638 silver, obviously much improved after-tax IRR and NPV. But I specifically want to talk about this, the $1 zinc scenario, $1 zinc, 85-cent lead, $15 silver. Look, you don't build this thing if that's your long-term forecast. But in terms of price shock, ability to survive price shock, you'll notice that in the first 11 years of the mine life, at those low prices, much below our base case, you're still cash flowing after tax very, very nicely. And so if you're assuming that the zinc market going forward is going to be like the zinc market has been in the past, which is to say there's periods where you're going to struggle and there's periods where you're going to make boatloads of money, what we've established here, that in the periods of low zinc price, you do not have to turn off the lights on this project. And then the periods of high zinc price, you are going to be printing money. And so in terms of major opportunities, obviously, a PEA is not a detailed, in-depth document. We don't believe in exploring optimizations too much in a PEA. You're working with limited data, so optimizing on limited data doesn't make a lot of sense. I got my picture of Justin Trudeau and Premier Sandy Silver there to indicate, to discuss a little bit about how they committed in 2016 $360 million in infrastructure investment to resource projects in Yukon. We believe they'll step up for our road as well. And so going forward, one of the things we want to look at this year is improving metallurgy, really right-sizing the pit, finding that Goldilocks pit size between the large pit and small pit scenarios we looked at that really maximizes economics. And I think everyone's heard me talk about exploration before, but to quickly, I'll quickly breeze through this. But the point is that, yeah, look, there's 11 million tons indicated and 39 million tons inferred here, but we've barely scratched the surface of the potential in this deposit. 18 years mine life is the beginning. We intend to this summer add high-grade tons, which will improve the economics. And that's it. Thank you very much.